Hello and welcome to Leviathan News. Today is June 4th, and I'm your host, Samuel McCullough. It's just me today. There's no DeFi advisor because he is in ETH Belgrade, enjoying the conference and learning out all about what's happening over the next few months of Ethereum. But he'll be back in a couple of days. So today we have on two guests, Bob Murphy and Cole from Infineo. And I wanted to bring them on actually because I have been interested in RWA products for quite a while now. I mean, it's been one of the narratives that has been driving a lot of institutional interest and also development across the industry. However, we've gotten this weird production over the past couple of years. Like in the beginning, the whole RWA trend was like, okay, hey, we're going to securitize everything. We're going to throw all these stocks on chain. You're just going to move your entire stock portfolio into a crypto wallet and that'll be it. But we didn't really get that. What we have gotten is the issuance of short-term debt, treasuries, and other types of sovereign U.S. bonds into tokenized form that have been distributed out as these number go up tokens. And you can see this with like USDM and with a variety of other products that are offering short-term treasury yields to a variety of institutional onshore, offshore investors. And we haven't really got anything else. We don't really have stocks or options or anything particularly securitized that is a security that has been moved on chain yet. But I think we're getting to a place now where that might be changing. And so today we have on Infineo to come talk about that. So welcome, Cole. Welcome, Bob.
Thanks for having us.
Yeah. So like where are we in the whole evolution of RWA on chain? Like, why can't I trade my stock portfolio in my crypto account yet?
Well, I think the simple answer is that there's no secondary market. There's no market making, and that's a big reason why there's no secondary market. So, I mean, what does that really mean? It was just simply, in my opinion, end users just haven't kind of figured out the value of doing it. And I think fundamentally the blockchain, I mean, let's just be honest, blockchain is still, widely misunderstood, whether that's institutionally or at retail. It's still widely understood. You say blockchain to a lot of people and their eyes cross and they think of like Sam Bankman-Fried or something, unfortunately still. So there's that kind of hurdle, kind of that adoption hurdle and that credibility hurdle to kind of, get through, even though, BlackRock is issuing BUIDL on Ethereum, which is, as credible facing, SEC facing fund as you can get. I still think there's a big kind of adoption curve. So I would go reasons why credibility, need, right? So like, do you need to securitize these things? Can you buy it in the analog or do you need to buy it digitally? So it kind of comes down to blockchain use case, credibility. And then for me, it just kind of really just gets down to logistically market making primarily.
Right. So I want to talk about you guys, right? So if we take a look at RWA.xyz, which I think is fascinating, it's been about $12 billion of total loan value and about $8 billion worth of active loans right now. And the majority of that has been issued through a platform called Provenance, or a blockchain called Provenance. It's essentially been developed by Figure. And Provenance was actually one of your investors into Infineo, weren't they? Or you guys received a grant, right?
Yeah, hash token grant. Yeah. And Provenance is like the only game in town when it comes to RWA. But they have, and we're super good friends. Like I'm really good friends personally with the CEO, Anthony Morrow, and the entire team. And I mean, Provenance we spent, like, Bob, how long did we take before we chose Provenance?
I mean, it depends when you start at least several months of just reviewing the pros and cons with our tech team of various blockchains. And yeah, like Cole say, Provenance, just in terms of they really understand financial markets. When you talk to them, you can tell they're not bluffing and they understand, blockchain technology, but also New York City financial markets. And so that was the team that we really felt comfortable with.
Yeah. And I would agree with you on that. Like, I think that Figure had a mission, which was to go out and figure out how to use blockchain technology. They issue billions of dollars of loans a year from their current company. Just to give a little bit more history on this, the founder of Figure was also the founder of SoFi as well too, and so he left SoFi, founded Figure, and said, "Hey, we're going to create a blockchain on the back of this that can handle a lot of the issues that I ran into running SoFi and seeing how these secondary markets for debt work." And so Provenance, the way I understand it, is this almost like a walled garden where you have companies, like regulated companies like Figure, that have issued loans and then need to essentially sell those loans on to investors. And they created a market for that on Provenance. And so for a long time, they were the only company that was there. It was essentially Figure and then a bunch of funds who would buy their loans through their system. But I perked up when I saw Infineo, because it would seem that you guys would be the second major company that would be coming into Provenance and essentially establishing a system to move beyond just what Figure's doing and create new markets that just aren't the home loans and other types of loans that Figure's doing. And essentially, you guys would be focusing on term life insurance.
Yeah, whole life insurance.
Whole life insurance. Sorry.
Yeah, it's for sure. And I mean, you're right. Figure have done. Mike Cagney and Anthony at Figure and the entire team, they figured out a good use case. I think really kind of coming back to that, I think that's just the core message for me, at least, is do you need blockchain for that, really? And the Figure team figured out a way to either pass more value along or make more money for stakeholders using blockchain, but without showing the use of blockchain, like not having to flex your crypto muscles and say to the world, look, I'm using blockchain. It's all abstracted out. Like when you go to figure.com, you don't know you're using the blockchain, really. And that's a really, I would say, humble way to be successful using blockchain. And it's just really about lending. It's about an e-note or, leveraging uniform commercial codes that adopt language around NFT and, tokenization to issue loans cheaper and faster.
Mm-hmm. Yeah, that was the big thing, that their whole raison d'etre. Like, sorry, I can't speak French. I've tried several times, and
I studied it for 8 years, and I know how to say my name and ask where the bathroom is.
And raison d'etre, Bob.
Yeah, three things. Trois things.
But shouldn't the R be like silent in French? That's what the thing that always gets me. Yeah,
you're supposed to roll it or something
Yeah. Which I can't roll my R's as well too. I go to France and it's like, je m'appelle Sam, like one of those people in the movies. But their whole reason for making it was that they wanted to have instant settlement or near instant settlement and bring those costs down. I think that they showed that they could reduce a lot of that backroom administration work by something like 90%. And so they would essentially pass those fees back on to the companies that are using them. And so I think I've been waiting for Provenance to kind of have its moment, and hopefully with you guys, this is just another key that can open up what they're doing over there. Because I do think they've built something special. It just hasn't gotten the visibility that's needed yet. And so I think it's really important for people to understand that there are more RWA products coming. And it's just a matter of getting the building blocks of having the network there, of having understanding the backroom administration stuff, how everything gets processed post settlement. Having that also, companies like yourself can come in and focus on just building good products and acquiring users, and having a product that people would want to hold as like a collateral asset for whatever they want to do in DeFi.
Well, just to connect, what we're saying now with what you were asking originally, Sam, I think you could just see the contrast in the blockchain, use case for what we're doing versus, like you said, stocks. I have no doubt that in the year 2050, lots of stocks will be on chain and, thing. But you're right. The adoption hasn't been that fast. I think it's because of what Cole was saying. it's pretty easy to log on right now to your, your brokerage account and do things. Yeah, like maybe you can't trade a stock on Saturday or something, but other than that, it's not too cumbersome. Whereas with what we're doing at Infineo, taking whole life policies, tokenizing them, and then allowing people to trade, the tokens rather than the underlying, issue. Like right now, if you're an institutional money manager, you can't just say, you know what, I want to get, $10 million of exposure to whole life policies with these characteristics. Like you just can't do that. It's a very cumbersome process in the U.S. If you tried to go buy policies from someone else, you need special licenses. So that's the kind of stuff that we're just, taking off the plate of a potential investor, and having whole life insurance now as an asset class that can be purchased at scale. Like we're taking care of all that stuff, paying the premiums and everything all under the hood. And you just need to know, how does this asset class compare to, traditional fixed income or real estate or whatever. So I think that's why our use case is so much more compelling than a lot of these other assets.
Yeah. So I do want to ask a question about that. So normally in like a traditional, I was always raised to say that okay, you want to go build a portfolio, just make 60-40, 60% allocated towards you could do a three asset portfolio, right? Like the S&P 500 plus international stocks, and then some like bonds as well too. You throw that all together, and there you go. That's your portfolio. But I never really knew that you could invest into whole life insurance and collect premiums. I saw some documentation that you guys shared in the pre-show stuff, and showed that the like whole life insurance has yielded pretty well over the last 50 years, 100 years, and the returns are pretty consistent, and you kind of escape the volatility that you would have with equities or even bonds as well too.
Yeah, I'll chime in, and obviously Cole, if you want to add to it. So right, I mean, this is like our bread and butter right here, the stuff we're talking about. So yeah, just very briefly for your audience, just to understand that, right, with whole life policies, if you hold them long enough, they get to a stretch of their lifespan or their life cycle where, yeah, you're earning returns in the high 4s, even low 5 percentage points, in terms of current interest rate environment. And that's if it's in the U.S., there's tax advantages too there, right? It's if you handle it properly. And on top of all that, it's the value of these policies, because you could always just surrender it back to the carrier. So it's called the cash surrender value. That just marches up over time. And once it goes up, it can't go down. And so that's why they're even safer in that sense than like treasuries from the investor's point of view, because as we've seen, like with Silicon Valley Bank and so forth, you could be sitting on, the world's safest asset, U.S. treasuries, but if they are long duration and interest rates spike, the value goes down. Whereas these policies, there's a built-in floor. Even if interest rates spike, even though in a sense it's a fixed income product, the market value doesn't drop, because you can just always surrender it back to the carrier for whatever the cash value. So that's why it's a very interesting asset, especially like if you could get a pool of them. But like I said, there are some frictions right now. It would be hard for a money manager to just go grab 10 million of it and then hold it and see how it does, and then maybe unwind. You just coming and going from it, getting individual policies that are heterogeneous. You got to make premium payments on some of them. There's different carriers that are kind of, perhaps sleepy. They're not used to moving money in and out and whatever. So there's lots of frictions. But if Infineo is managing all that, we have all the policies in an SPV and are issuing tokens that are fractional claims on the aggregate cash value, which is just one of the products that we're developing, then that's something a manager can get in and out of as long as they have the ability to own digital assets. So that's how we're just really revolutionizing this space.
Yeah. So I would say that the way that crypto or DeFi, blockchain, whatever you want to call, really unlocks any securitized product is in two ways. First, if there are dividend payments, you can make them in stable coins. And so those payments can be made on a streaming basis. You could have them made daily, once a week, and the dividends just get paid straight to your address. The other thing that I can see is that the ability to enable instantaneous loans. So when we're talking about these whole life insurance products, like you said, the collateral asset value doesn't go down, right? You kind of have a fixed amount which that you can use as a collateral asset, and it's better than using it as a treasury, because the treasury value can go up or down depending on interest rates. And so with this, you know that, okay, I have a $100,000 worth of this tokenized life insurance based on whatever the current rate of, or the current Oracle amount of how much value is in that right now, I can take a loan immediately for 80%, right? And that can be issued with in a very easy way.
That's right. I mean, that's a really good use case, and a lot of times it's 100%. And I mean, even in some cases now, Bob, the economist, may kind of argue with me on how I say this, because I'm not an economist, but I'm a founder. But so I'll speak for myself. I own 14 life insurance policies, 2 of which, if I put $100,000 in, I can take more than $100,000 out annually. So if I make a $100,000 premium payment tomorrow, I can turn around and take on one of them about $104,000 out, just because it's an older policy and it's kind of past that break-even point, if you will, so that the vehicle is paying me back more than I'm putting in, essentially. And the other thing is that it's life insurance, so it's buying me life insurance as well. So if I get hit by a bus, even though I'm taking more than I'm taking more out on a collateralized basis that I'm putting in, there's also a death benefit that pays out to my beneficiary if I get hit by a bus on my way to Starbucks today. So there's all those features. So if you think about the friction that I had to go through personally to own that policy and to nurture it up to the point where it's doing all of that stuff, super painful. I mean, it was like 7 years of my life, massive amounts of needle poking and blood and peeing in cups and medical and financial underwriting and questionnaires and waiting. And I mean, it was just really painful. So, are Bob and I, passionate about, I mean, the word democratization in our industry is really kind of abused, I would say. But I mean, are we excited about democratizing it? Yeah, that's an understatement. I mean, I think that's what kindred Bob and I and brought us together, was being able to understand how the use case of blockchain and how blockchain actually can help people around the world have exposure to what I just described.
Mm-hmm. So
also, if Sam, I could just piggyback on that, just to emphasize your point, and to coincide with what Paul's saying, that we're right now just again underscoring why this is such a good blockchain use case scenario. Because even if you were a hedge fund or whatever, and you saw the benefits of what Cole's talking about, and realized, oh yeah, we could just get into this market and we just wait long enough, and the policies get to the point where they start they have built-in liquidity, you can borrow. But if you're sitting on 100 separate policies and you wanted to borrow against them right now, like, you would have to contact each carrier and borrow the little amount. Whereas if you've got them all in a pool and then there's tokens issued on it, and then we have arrangements, which we do with, third-party lenders that understand the nature of that collateral, and they see and so forth. So technically, we're routing the loans, through the chain and smart contracts and whatnot to the people holding the tokens. You can just see how that's a lot more efficient, that they're just doing one transaction. Oh, let me borrow against the aggregate value here. They're not having to go out to call individual carriers and have 19 separate loans, and they have to keep track of the different loan balances on each policy, which is like, I know people right now who use this whole life insurance for this purpose and for cash management, and they have to have like an Excel file just keeping track of all their policies and what's the loan and what's the rate, and we take all that off your plate.
Do they have, so for real estate, this would be like a REIT, really? Do they have a, what is it, life insurance investment trust? Is that what they're called? Or
no. I mean, the closest thing would be seen in what would be the life settlement industry. And there are life settlement companies. I think really what we're talking about now when you say that is a secondary market, really.
Yeah.
So the secondary market for life insurance has been, in the United States and many countries around the world, life insurance is considered property. In the United States, it's been considered property constitutionally, reinforced many times in various courts over the last 100 or so years. Since 1911, the property can be traded like any other type of property that you own, whether if it's real estate or gold or whatever it is. So there's no, say, trading discrimination applied to life insurance that a lot of people. So then it's like, well, why isn't there, if these things are so valuable, why isn't there a secondary market? Well, it's because of how Bob kind of described the friction. So to answer your question, Sam, The only real secondary market for life insurance right now is in the life settlement industry, or some people may know it as what would be the viatical industry. So just to be really clear, that is not what we do. We do not trade life settlements. We do not trade viaticals. We are not interested, in that business. But that is, and I won't get into what all that stuff is necessarily, but it is not what we do. It's like everything we do everything that's not those.
Well, I wasn't talking about like trading of the assets. I was just thinking about you think about like how a REIT operates. They essentially acquire like a bunch of property, comes into this legal wrapper, and then obviously they have operational expenses to make sure that everything's working and administered correctly. But then the property that they hold generates a dividend on a quarterly or yearly basis. And so it seems that this would be somewhat similar to that, where you're getting a bunch of policies into a legal wrapper. There's kind of one aggregate, in your guys' case, token, which represents the full portfolio composition of all these policies. And then there's a company, an operating company, that handles the administration and everything to make sure that these policies are valued correctly and are taken care of from the tax perspective. And then the investor just has to buy one single thing at the top, which would be the token, the security token, and then they can use that for whatever they want. They can hold in their portfolio. It'll capture the income that comes through the assets that you guys hold in the portfolio. And then if they want to use it to take a loan out, there's just one single price, which is representative of that token itself. And it makes it really easy to go out and get liquidity or do whatever they need to do with it.
Yeah, that's essentially what you're describing is kind of essentially one feature that we are doing. But I mean, in my opinion, I have to correct you though, because you said you weren't talking about trading, but what you're describing are ingredients to lead to a trade of a policy. So it is about trading. It's all about trading. Everything that you just described is like to get to a trade. And that's why, so yeah, I mean, that's what we're doing. Essentially what you just described is essentially how you tokenize life insurance.
Right.
And also, Sam, just to correct, so because you had earlier asked us, does this exist? Right, the REIT model, is anyone doing that in life insurance? And that's why Cole was saying, no, to our knowledge, nobody's doing what we're doing right now in terms of that model. The closest thing is, yes, there are investors who do sometimes have like policies, but they're buying it, because the person's got a medical condition, or so it's not for the cash value play. It's they're just waiting, for a mortality event, and that's not, we're not interested in that spectrum of the market. So what we're doing, yes, it's that one element of what we're doing is sort of like a REIT for the reasons you described. And to answer your question, like, yeah, no one's doing this.
Well, if these things yield the way that you kind of say they do, or at least the documents that you shared do, and I think the average return was like 8%, 8.2% over the last 50 years. If they yield like that, how come nobody's done a REIT style investment product that would allow? They've tried.
Oh yeah. There's a couple of companies, like significant companies over the years, that have tried to do it. But Bob, is that IRR number that he's saying? Is that right?
Well, he said over 50 years. So remember,
50.
There are periods there where interest rates were a lot higher.
Yeah, got it. Over 50. Yeah, okay. Sorry, I missed that piece. Yeah. But yeah, no, Sam, that's the ultimate question, right? Is like, why are more, this is one of the big questions, is why are more people why is no one doing this? Right. That's when we decided to invest, millions of dollars into kind of standing this up in kind of years of our life, that was one of the big kind of risk questions at the beginning, is why doesn't this exist? Why, this is so obvious. Why doesn't it exist? And the reason it exists, thankfully, is because blockchain didn't exist, and AI to some degree. But now it's just the technology has kind of caught up to the problem. And there's companies, there was a company out of Singapore that tried to do this in 2017. And again, the technology, wasn't there. They even tried to use technology, AI and blockchain. They couldn't get there because it just wasn't, especially on the AI side. The blockchain was basically there. I don't think tokenomic models were as advanced, obviously, as they are right now. RWA definitely didn't exist or like it does now. And And even now it's super nascent. Like RWA is like, we got to be honest, it is so early still. We got to remind ourselves how early we are, how patient we need to be, and how collaborative we need to be, right? That's the key thing. We need to be super collaborative right now. There's no competition. We can't think in that way. Unfortunately, people are in RWA already, and they're the ones that are they're gonna crucify themselves. But yeah, and then there's been analog companies over the years who have just tried to, like traditional, funds who have tried to like do an insurance version of a REIT in the same way. And it just, the problem is that all the profit is evaporated, out of the project just because of the friction, the administrative friction that blockchain solves. So that it's just, you can do it, but what's the point of doing it if you're not making money? So a lot of these companies kind of got down the road with it and realized that, oh my gosh, we're moving these ownership changes around and issuing liens against this and trying to package this. And then you couldn't issue tokens at the time, but you could issue, say, fractional shares, and then the regulation around it. I mean, next thing you know, you're turned around and you're like, cool, I got this great project, but either we're losing money or not making any money. So what's the point of doing it?
So now, why is there no economy of scale then? You would think that, okay, well, I'm going to start this new investment company. I'm going to get $1 billion worth of whole term insurance policies under my wing.
Yeah, whole life.
I should be able to streamline all those back-end operations, right? Like, why was that not possible with beforehand? It was just the inability to handle digitization of the policies or to do all the management, like you're talking about the liens and
the question had economy in it. So Bob, I'll leave that to you.
Sure. Yeah. So I'll take a shot. Just so a lot of moving parts, and partly, Sam, the issue is for what we're doing. So for someone to really get it, you kind of have to know how blockchain works, and you have to know the ins and outs of whole life insurance, and that the Venn diagram of the intersection of those two is actually not that big. But to answer your question, you're right. There are economies of scale, and that's why we're doing this. But to help explain this sounds like it's just kind of like a REIT, except with life insurance. It's in many respects, it's a lot easier to buy the house from the guy down the street than it is to buy the life insurance policy from the guy down the street. Right. Again, you need, if you don't have an insurable interest in the guy, then there's special, you got to go through firms that have special licenses. The states all have different regulations. And so it can be done, but it's again, the kind of thing. And also there is in certain sectors of the financial world, this stigma, against whole life insurance. And so there's a lot of headwinds against this. But again, we know that there's a market. We know people who are doing this right now, just even with conventional analog policies. And we are just trying to, give a service to them or to make it for the institutional investors. So it does work. You're right that there are economies of scale, and that's partly why we're going ahead and building this. But we have seen just all the different frictions involved why this doesn't exist yet.
Yeah, I mean, the way that you guys explain it, you have a token and it goes up 8% a year. Compounding. I mean, that sounds really nice.
Well, just to be clear on that one. So like Cole was saying, right now it wouldn't be going now it would be going up at whatever 4.8%
on average, right? Yeah.
It's just that 50-year stretch includes periods where interest rates were higher.
Okay. So even if it's like 4 point whatever right now, it seems pretty good, especially when there's no like price risk on the asset itself, right? You're collecting cash, right?
Right. Yeah. So, I mean, you're right. Like we're excited about it. It does make sense. But again, with a lot of people, I mean, we talked to very savvy financial people to, explain a bit. And some of them were like, well, it was my understanding whole life earned like, 1.5%. Like, if you're really Dave Ramsey, Susie Orman, like they'll throw things like this. So if someone doesn't independently know the research on this asset class, they have all these misconceptions floating around. And so, there's that hurdle as well.
Okay. So, let me just take a step back, and we can come back to the figure part, or sorry, the provenance part. So is your company going to be originating these policies?
Yeah.
Okay. So you're in the business of originating policies similar to how Figure is originating like home loans or personal loans for people.
Different. So we're gonna take existing. So what Figure is doing is they're standing up novel loans. They're creating new loans. digitally native loans. So what will be digitally native for us? So it will be the loan. There will be a feature into our marketplace that we're building right now, where what will be digitally native, and this is one of the key use case comments, will be a loan. So like you would get a loan against the second position loan, like a HELOC or a mortgage, like Figure is doing, that's digitally native, which is totally perfectly blockchain use case. I mean, that's amazing. We would be doing the same thing for life insurance. So remove mortgage and put in what we're collateralizing instead of a house is a life insurance contract. So that's digitally native. But then our origination, we'll also be originating these in the primary market, moving them into the secondary market, kind of as mentioned. So then they would not be digitally native. Essentially, we would be basically taking an analog, like a paper life insurance contract, and then turning it into an NFT or a BNFT, backed NFT, essentially. And then from there, then you can further fractionalize it and break it down into kind of smaller pieces.
Okay, so you'll have people coming to you with their existing whole life policies. They say, "Hey, I want to get some cash out of this. Can you front me some cash?" And you guys will issue the loan, and then you'll use Provenance in the same way that Figure's doing by taking that loan and essentially selling it off to institutional investors or other types of investors that can access the market, who would want to get access to those income streams.
Yeah, that's an option, or we could just kind of keep it retail, as well. I mean, the idea would be in a perfect world, what you would do is you'd have enough scale to be able to sell these off, tranche them, block them, rate them, sell them. That would be the perfect, in a perfect world. You will have arrived in that case. But yeah, that would be the goal. And until we get to that point of scale, then we could just kind of keep the product retail. So you wouldn't be going through the rating process, the tranching process at that time. We would be lending people money against their life insurance policies, and we would make money through yield essentially on those loans.
Right. Okay. Yeah. And then you could turn around and people would essentially buy well, I mean, you talked about the tranching and everything, but everything we get like wrapped up into one aggregate token, which then people could buy. And that's what would be sold on Provenance, right?
Right.
Okay. Yeah. Cool. And then that token just goes up year on year, like 4% right now. Maybe it goes up to 5%, depending on interest rates, or 8% or more. Who knows? Maybe it goes down. What were the returns during the kind of super low interest period of the 2010s?
They were still okay because there's like sort of a lag, right? So a life insurance company, it's taking in premium payments, and it goes and buys fixed income, corporate bonds, some treasuries, things like that. Mm-hmm. And they're trying to match their liabilities and their assets, right? So like their actuaries tell them, given our book of business, we expect mortality events and death benefit payments over the next 60-year horizon in this. And so then they try to go match assets to match the cash flows, so that interest rate movements don't kill them either way, right? So they're kind of hedged because either their liabilities and assets go up or down. Right. So given that means there is a sort of slow turnover process that is, interest rates secularly declined. The rate of return on the carrier's portfolio was also falling, but there was a lag. So what I'm saying is that they were higher than like what you were getting on T-bills, in that stretch, but they were drifting down. And had rates stayed low indefinitely, like there were people in the industry like wondering, what are we going to do? And like, do we have to start moving into riskier things just to make the yield, or do we just reprice the products and just sell policies that have a very low predicted rates of increase over time? But rates came back up before they really had to decide. So to answer your question, rates did trend down, but they were like a lag, and then there was just a period there where the carriers kind of just ate it. And the customer saw like relatively attractive rates of return, compared to what you were getting in the short-term bond market.
Right. And now they're kind of like they're lagging behind the short-term treasuries as well too. While those are at like 5, the rates rate for the whole life insurance are like at 4.
It's hard to give you a number because again, like there's lots of factors that go into it. So right, that it's more they would track like, you know,
They try to smooth it out over.
treasuries.
Yeah. Okay.
So yes, right when interest rates flip, it takes a while for the bond portfolio to turn over. But again, they're in more longer term things.
I think it's the easiest way for me, because I'm not an economist, right? I'm just like a startup founder. But for me, what it connected with me was when I learned about Sharpe ratio. Like the Sharpe ratio is really the thing, because and then I own a lot of these things personally as well, and I'm looking at charts that are showing standard deviation and IRR, and I'm like, okay, if IRR minus standard deviation is something called Sharpe ratio, what does that look like? And so we sent Bob out to do a bunch of research and analyze it, and we came back based on our study that the Sharpe ratio was around 3.2 over a certain period of time, and we can provide all the white papers and analysis of this. And then if we looked at other fixed income vehicles, Sharpe ratio, like hedge fund managers were piling into Sharpe ratio at 2. And so really what the Sharpe ratio to me, being kind of a layperson, meant was that I'm getting really very good risk adjusted returns. Like if I'm going to hold this over time, then I learned about this thing called yield curve. And as the yield curve is doing what it does, inverting on inverting, really it's kind of tied to the smoothing of my asset over this amount of time, which kind of came back to the Sharpe ratio. So these were all, things that financial people and economists kind of understood, but me just as a I was just enjoying owning all of these life insurance policies and just kind of like sleeping better at night and my life being really calm. And I'm thinking, well, if we could, again, package these things and issue a token against it, can companies and can individuals in emerging markets essentially own this and enjoy this? And the answer was yes, very, very easily.
Right. Okay. So that leads into my next question, which is who it's made for. So as a securitized product, these can only be sold under different exemptions that the SEC has. There's typically like 3, 4. The main ones that you'll see is either like Reg D or Reg S. Reg S is usually Reg S is for offshore investors, non-US investors. Reg D is for accredited US investors. And then non-accredited investors usually invest through either Reg A, Reg A Plus, or Reg CF. So which of those fund flavors are you guys using for the life insurance token?
D506C is our current exemption. And it just kind of suits where we're at, kind of with it. So that, as far as a security token goes, we feel as though that suit fits best.
So that means that it's U.S. accredited investors with a net worth of over $1 million. And then it also means that once the token is issued, there's a 1-year lockup period where the token has to be held. It can aggregate income from the life insurance, but it can't be traded on the secondary market until that 1-year period is over.
Yeah.
Right. Mm-hmm. Now, what about issuing through like a Reg S? Because there's much different rules around that. With a Reg S token, you're selling to non-US persons. There's no lockup, and you can create secondary markets immediately for the token, which potentially could be used to integrate into DeFi faster.
We just don't. I think it kind of comes back to one of the things I said at the top of the show which is just that there's no secondary market really. And I mean, we don't want to be the company that is going to try and create it, right? Because it's just too expensive, and how much this is not what we are really right now. It was just too early for Reg S, I think, is the answer.
Yeah. And then how do you get retail involved?
Well, that's the same. It's kind of the same. It's the same. Once we go Reg S, then we retail will be involved, and we're not like a company our size can't do that, or any company. Right. My advice to any company, and we've been at this for 2 years, my advice to any company at this stage, or who's bootstrapping, raising money, don't try and go retail. That's just my opinion. Let Larry Fink figure all that out.
Yeah.
Let KKR figure that out, right? Let Hamilton Lane, BlackRock figure all that out, right? They're doing it. They're doing all the heavy lifting for us. And let them fight with the SEC and the regulators and suck up all the oxygen in the room. And then let Coinbase, let if BlackRock and Coinbase come together to create market making, possibly, or maybe Citadel come in and create market making, or a guy like Mike Cagney. I mean, let studs like that have had multi-billion-dollar exits, solve all these secondary market retail kind of issues. It's just, that's when I say we're early, and we need to collaborate as startup founders. That's what I mean. It's just we can't dream in retail quite yet. I don't think it's still a couple years away.
Yeah. So Sam, I mean, we agree with the long-term vision that's coming, and that's what it's going to be. But like Cole was saying, like we're being very strategic and 1 foot in front of the other right now, and not trying to get ahead of ourselves.
Well, what would it look like for someone like me, like a U.S. retail investor who wanted to come and purchase the life insurance tokens that you guys are going to be issuing, like
today?
No, obviously not today,
but
like
today. But you can do that today. So we have again a 506D friends and family round open, and so you could actually get indirect exposure to the equity in the company, which would be all of the products that we offer as well. So our friends and family round, if you will, has been very good. Like our fundraising through 506D has been fantastic. Mm-hmm. We're cashing checks, every week. And the community that it's kind of bought into what it is that we're doing has been RWA community, crypto community, even the life insurance community. There's this infinite banking, kind of esoteric infinite banking, life insurance kind of community that's really embraced us, as well. So that's the way to probably get exposure today. And then as of Saturday, actually, this is a cool story. On Saturday, our CTO, Zuhair, we were at Consensus in Austin, and then he was on a plane back to Dubai. And while he was on the plane, we set a go live date for minting the world's first tokenized life insurance NFT. And he did that while on an Emirates flight between Austin and Dubai. And so as of Saturday, and I have the timestamp somewhere, it's in my phone, I can pull it up. We minted the first life insurance NFT on Provenance at that time. So the path to owning a digital exposure to our company versus kind of like, equity, traditional equity, is that path just got a lot shorter, if you will, as of Saturday. So we're really proud of that. It's a big deal. It's the first time in the world that life insurance has been tokenized.
Like a policy, right?
Yeah, a policy.
Oh, yeah. That's pretty cool.
Yeah, we're really proud of that. And so now it's public record. You can go onto the Provenance blockchain and you can see the evidence of that. And that's the beautiful thing. The thing about the blockchain is that now someone could just go and see that, yes, that. And the nice thing is that so that policy, so we practice what we preach. Our corporation owns what are called COLI, or corporate owned life insurance. So our corporation, our business, owns life insurance on all its key people. We own life insurance on Bob. The company owns life insurance on me. So we're heavily de-risked in the sense that if, like, again, I get hit by that bus on my way to Starbucks today, then Infineo receives a lot of money, millions of dollars that it owns as life insurance on my life. Now, what we were able to do is we were able to take that policy that Infineo owns and then tokenize that. So that's the first policy that we minted, me as the CEO and the founder, where that was the first policy that was tokenized. So it's kind of a cool story as well.
That's pretty cool.
Yeah.
So the idea then is to bring millions of policies under the umbrella, tokenize them all, put them all on Provenance, and then create secondary markets for people to purchase them as either an aggregate token, or you talked about later on to essentially like rate them and then issue them out as like similar to how the mortgage-backed securities were issued with different ratings.
Yeah, exactly.
It's pretty
right.
cool.
So there's just a whole lot of flexibility with all that. Once you tokenize the individual policy, then the sky's the limit. Like you said, like individuals can just borrow more easily against that. So that's more like the Figure model, where Figure's not creating houses. The houses already exist. They're just, the loans are what is being created. So there's that element. But like Cole's saying, if people, if some group buys a bunch of those and then pools it and then issues other things on top of, so there's all kinds of derivative structured products you can make once you have that original, like the basic atoms in now these new structures that we can build is an NFT, a one-to-one for a given, real life whole life insurance policy, and now this token that represents it.
Very cool. Well, I'm really surprised that there's never been a way to like easily invest into someone else's whole life insurance before. Like that's the thing that's kind of most boggling to me, is that for all the financial ideas and investment advice that you get out there, that nobody's really gone out and tried to aggregate all these policies into one place to provide like a way for people to just cash it. I mean, does the value of the token just goes up, or usually are these just paid out as dividends, or how does it work?
Think of it as like, so before Infineo was called Infineo, so Infineo, if you will, it was a kind of a catchy name. We were called Lifecoin, and the idea was that we were the unstable coin, in the sense that we were literally a stable coin. Was the original idea, is that we would build a stable coin kind of around life insurance, and we were the unstable coin. But the problem is that now our stable coin was obviously a security because of the upside, the arbitrage to the upside. So like our lawyers, which wouldn't really kind of sign off on letters of no action and kind of fight the SEC on the fact that our stable coin is actually stable, because it was volatile to the upside because of to your point, because of the life insurance component of it. And so we moved away from the unstable coin, which was fun. At one point we wanted to call it death coin as well, because the inevitability of, what we're talking about ultimately is kind of the scarcity of a human life.
Yeah.
Right? Like if you think about a non-fungible, like what is the most non-fungible thing in the world? Well, it's some kind of a document that would create some monetary valuation of a highly scarce object, right? Which is a human life. So we get kind of philosophical about really what are we doing? Well, we're kind of like essentially tokenizing a human life, because if a life insurance contract is the underlying mechanism by which that entity is valuated, right, through either cash surrender value or death benefit, hence death coin, eventually, if you trust the life insurance industry, which is arguably the most solvent business in the world historically, to make their claim to pay out the death benefit or the face value of that contract, then through digitalization of that policy, you're essentially tokenizing a human life. And so then I would argue, what is the most important thing in the world? Well, a human life is the most important thing in the world. So then when you're tokenizing this highly scarce, highly valuable asset, I mean, is that important? So I would suggest that what Infineo is doing at a very philosophical high level is vitally important. And then if every human life could eventually be evaluated through tokenization and then democratized, we're really doing a lot of good.
Well, very cool. Well, I think we can wrap it up there. We're at the top of the hour. And it was great to hear about what you guys are building. I think it's pretty novel, and pretty excited to see how this runs on Provenance. And it's good. I'm really happy we got together and we got to do this. So I learned a lot about the insurance that you're tokenizing, and I hope that it really goes well for you guys.
Well, thanks so much for having us.
Appreciate you, Sam. Thanks for the time, man. This was a really fun conversation.
Yeah.
Thanks for buying into our community and what we're doing. It's really important.
And for anybody that's interested, where can they find more interested about Infineo?
Well, our website, we can find us, you can,
Infineo.ai?
Yeah, .ai, yeah.
And both of you are on Twitter as well too, right?
Yep, I'm Bob Murphy Econ. Lots of trolling and silly posts there, but yes, also a lot of life insurance education.
Great. What about you, Cole?
LinkedIn, I have a Twitter as well, at Cole Snell. Proud to say I'm a 50-year-old man without Instagram. very proud of that. Yeah.
Very cool. You can find us at Leviathan_news, both on Twitter and Telegram. We will be back tomorrow. We are going to have on Matt Dobbill from Gauntlet to come and talk about some fun stuff. So we will see you all tomorrow. And thank you, Cole, and thank you, Bob, for being here for this great discussion about Infineo.
Thanks for having us.
Thanks,
All
Sam.
right.
Appreciate
Thanks,
you.
guys.